Let's jump into problem 14.3a, bonds issued at a discount, and we are doing the effective interest method. That's good news because that's the one US GAAP, Canadian ASPE, and IFRS all recommend. If you're looking for the straight line method, that's 14.7a and 14.8. So let's jump into the effective interest method. On February 28th, 2031, Tiger Inc. issues a $1 million of 10-year 9% bonds. So our bond is promising to pay 9% interest, annual interest. The market rate of interest is 10%. Okay, so we're promising 9%. The market thinks 10% is the right number for us. Therefore, nobody's going to buy our bond at 9%. They're going to take a discount. Because the market rate is higher than the bond rate, the bonds issue at a discount. The bond quote is 93.769. That means we asked for $1 million. We got 93.769% of the money, and $1 million times 0.93769 is $937,000. So I always start with a journal entry in these questions. So Feb 28th, 2031, let's debit cash, 93,790. We're going to credit bonds payable for the full $1 million. And the difference goes to an account called discount, or discount on bonds payable, to make this balance. Now, some IFRS related textbooks will actually just credit the bond payable for 937,690. They do it the net method. It's not very different from what we're doing. I think even if you're doing the net method, you can still follow along, and I'll comment as we go as to what's going to be different. So if you're doing the net method, debit cash, credit bonds payable 937,690, but we're going to do debit discount here for the difference. And the difference, well, let's put this in as negative, plus $1 million, 62,310 is the amount of our discount. Okay, so what the heck is a discount, right? Okay, we issue the bond, we go, okay, we're not paying a competitive interest rate in the market. You know, the people buying bonds won't pay full price. They pay a discounted amount. They give us $937,000. We got to pay them back $1 million at the end of this 10 years. This $62,000 is extra interest. That's all this is. This is just extra interest. If I borrow $90 from you and pay you back $100 a year from now, well, the $10 is interest. Well, this $62,000, this is interest. The question is, when do I recognize the interest expense? And the effective interest rate method says, follow the table to recognize your interest expense. Straight line just says, well, it's 10 years, 10% per year. Divide by 10 and on you go. The effective interest method says, okay, we're going to recognize it slowly over time according to the results of this table. So I'll show you how to prepare the table. In fact, why don't we do it? So I'll just read on. The bonds pay interest semi-annually on February 28th and August 31st. In our class, in this chapter, it's everything's semi-annual. And that means twice a year. The company's fiscal year end is September 30th. Prepare the bond amortization schedule for the issuance and the first two interest periods. Okay, the issuance was Feb 28th, 2031, and on the issuance date, there's no payment, there's no interest expense, there's no discount to be amortized, but there is a discount balance. We have a discount balance of $62,310, just looking at my journal entry, and the bond carrying amount, you can see it's discount, so I'll scratch out premium. It's the number you put in here is the face value of your bond, so it's $1 million minus whatever's in column E, $1 million minus 62,000. It's actually the amount of cash you got, 937,690. That's what goes in here. And if you do the math, $1 million minus 62,310 equals 937,690. Okay, this table will just cover 6-month periods. So February 28th, 6 months later is August 31st. 6 months later is February 28th. And 6 months later, or 2032, and 6 months later is August 31st, 2032, and so on. And it would go for 10 years. So that's 20 lines, right? These are 6-month periods. So it's a long thing. This is, done more quickly in Excel, but I think learning it, I learn better by hand, and I certainly explain better doing it by hand. The interest payment amount is the amount we've promised to pay. We've promised to pay 9%, but remember, that's an annual interest rate. We want to convert it to semi-annual, just divide by 2. So it's 4.5% that we're paying every 6 months. The interest expense is based on the market rate, the yield to maturity, and again, it's 10%, but we divide by 2 to get semi-annual, it's 5%. We've got discount amortization, not premium amortization, and we got a discount account balance, not a premium account balance. Okay, at that point, the table is set. These things, the challenge here is setting the table. Once you sort of start filling it in, it's not too bad. Interest payment, it says 4.5% of the maturity value. Our maturity value is $1 million. 4.5% of $1 million is $45,000. 5%, our interest expense is 5% of the preceding bond carrying amount. The preceding bond carrying amount, $937,690. I'm going to take 5% of that. 4688, I'll round here, 5. 46885. Be careful about rounding. Your professor might want you to go to the penny. They might want you to go to the dollar. Read the question and sort of read the room in terms of what you're supposed to do. C minus B, 46885 minus 45,000 is 1885. Discount account balance is E minus D, 62 minus 1885, 62310 minus 1885. 6425. And the last one, this is one people screw up. They go 937 minus 60. No, it's $1 million minus 60. $1 million minus 6425. 939575. And if we're doing it right, sorry, that's a little messy. 939575. If we're doing it right, this discount number is getting smaller and smaller and smaller. The idea is after 10 years, after 20 lines of this, 20 rows of this, it's going to be 0. And the bond carrying amount is getting closer and closer to $1 million, closer and closer to that face value number, and it is. So we're on the right track. If one of those is going in the wrong direction, you know you did something wrong. Let's continue. Our second interest payment is $45,000 because it's 4.5% of the maturity value, and that number doesn't change. The investor who buys our bond wants that steady eddy cash flow. We as the borrower want the steady eddy cash outflow, right? We want certainty around our borrowing costs, and that's what a bond offers. Interest expense, 5% of the preceding bond carrying amount, 5% of 939,575 is 46979. The difference here is 1979. 60,000, 425 minus 1979. 6425 minus 1979. 58,466. No, 446. And last but not least, we go $1 million minus 58,446. And we get 941,554. Okay. So it said prepare a bond amortization schedule for the issuance. That was the first line. And the first 2 interest periods, those are the next 2. There's an extra line there. If you want to keep going, you can. Now it says do journal entries for the issuance of the bond. That's that one. And that's covered by this first line, right? This line is the issuance of the bond. And you can see the numbers are matching my journal entry. The next line is, well, the next journal entry is for August 31st. And look at that. We got an August 31st line on our table. If you have the line on your table, it's an easy journal entry. And this is an easy journal entry. Why is it an easy journal entry? We just pull the numbers off the table. So the table is the hard part. But once you get there, the journal entry should be easier. Although I will say, a lot of times when I get students to practice this for my class, they get really good at the table and then they forget the journal entry. So you got to know how to do both. Anyway, because it's just a number from the table, you just go, okay, my interest payment is $45,000, credit cash $45,000. Interest expense $46,885. Well, of course, that's a debit. Interest expense $46,885. And discount amortization, our discount was a debit. I'm trying to make it go to 0, so I credit the discount to make it go down. $18.85. Now, if you were doing the net method at this moment, you wouldn't credit the discount, you would credit the bond payable. So remember, you would have gone debit cash, credit bonds payable, $937, and now you credit bond payable for $18.85. That's the only difference here. Other than that, it's the same. Okay, what is happening though? So our interest, so we pay $45,000, but we recognize $46,000 in interest, $46,885. Why is my interest expense higher than what I pay in interest? And the answer here is the discount. I'm recognizing, I said, well, there's $62,000 of extra interest kind of built into this by the nature that I only got $937,000 of cash. I got to pay back $1 million. There's $62,000 of extra interest. I recognize it a little bit at a time over the life of the note. And so in this one, 6 months, the first 6 months, I recognize $1,885 of extra interest. So I pay $45,000, but I recognize $46,000 of interest because of the discount. If we have a premium, it works the opposite, where we recognize less interest than what we pay over time. But we'll deal with that in 14.4a. Let's continue. So it was August 31st, 2031. The next relevant date is our fiscal year end, which is September 30th, 2031. Kind of interesting. It's not a December 31st year end. That happens all the time. And that is 1 month later, right? So when we want to continue in the question, we actually want to look on to the next line. And remember, that line covers from August to February, August 31st to February. So don't count August. It covers September, October, November, December, and then January, February of 2032. And we're interested from August to September. We're interested in just the month of September, which in terms of what's going on this line, I might have drawn the line in the wrong spot. What's going on in this line? It's just 1 month. It's 1/6, right? Every line on this is 6 months. It's semi-annual chart, and this is 1/6 of what's going on the line. So let's deal with it. Our interest expense is the interest expense here, 46979, but 1/6 of it, 46979 times 1 divided by 6, 7830. So our interest expense, 7830. Our discount amortization, 1979, again times 1/6, 330. So I'm going to credit discount 330. And remember, a discount started as a debit. We're amortizing, so we're making it smaller, so we're crediting it each time. And then we credit not cash, we credit interest payable. And the reason we're crediting interest payable here is because it's not a payment date, right? We pay only on February and August. Well, it's not February or August, it's September. So we're not making a payment today. It's just interest that's accruing. And $45,000 would be our payment times 1/6. 7,500 is the first month that's payable. Okay, one more entry to do, and that's on February 28th, 2032. And what's February 28th, 2032? Well, it covers the months from September 30th to February. So October, November, December, January, February. It's 5 months. And look at that. We did 1/6. Well, guess what? Now we got to do the other 5/6. So let's get after it. Same line. We're just doing the rest of it. So 46,979 times 5 divided by 6. 39149 is our interest expense. 39149. Our discount is 1979 times 5/6, pardon me, 1979 times 5/6, 1649. That's the credit to discount. And now we credit cash, but we credit cash for the full amount because we pay $45,000 every 6 months. So we're going to have to pay these guys $45,000. And what we find is our journal entry doesn't balance. I have 45,000 plus 1,600, 46,649, just the sum of those two, minus 39149. I'm off by $7,500. I'm missing a debit of 7,500 to make this thing balance, right? Debits don't equal credits otherwise. Well, what's the missing debit? Hopefully you're yelling at your screen. Hey, it's the interest payable because, of course, I paid the interest, so it's no longer payable. I got to get rid of my interest payable, and that's what I've done. So at that moment, I think we've done a wonderful job. I'm busy patting myself on the back. If you got to the end and you feel like, yeah, I feel like I can do this, I hope you'll pat me on the back too. Hit that like, hit that sub button. And if you're looking for the straight line method, that's 14.7a. That's in the appendix to the chapter. Thanks for watching. See you in the next video. Bye for now. The next video in our series is right up here. And if you want a supercut of all of the videos in this series, that's the one down below.